Your parents say buy. The internet says rent and invest the difference. Your coworker who just closed on a house says it's the best decision he ever made. Your other coworker who just closed on a house says he hasn't slept through the night since the inspection report came back. Everybody has an opinion on this one, and almost nobody has run the actual math past month one. So, let's do something different. Let's take two people, Idris and Usman. Same income, same city, same budget, same amount of money saved. One rents, one buys. And instead of arguing about who's smarter based on vibes and family advice, let's track every single dollar. Rent increases, Islamic home financing, property taxes, maintenance, home appreciation, investment returns, closing costs, opportunity cost. All of it for 10 years, 20 years, and 30 years. Because when you lay it all out on a spreadsheet and let the numbers run, one of these two people is quietly building wealth and barakah, and the other one is silently bleeding it. The gap after 10 years is uncomfortable. The gap after 30 years is devastating. And which side wins is not the one most people expect. My name is Adam, and this is Brother Explains Money. Let's set the stage. Idris and Usman both earn $58,000 a year in a mid-sized American city. They've both managed to save $60,000, and they're both looking for the exact same thing, a 3-bedroom place in a decent neighborhood with a reasonable commute to work. Usman buys a $300,000 home. To avoid interest-based debt, riba, he uses an Islamic home financing model called Diminishing Musharaka. It's a partnership where the bank and Usman buy the house together. Usman puts down his $60,000 as a 20% down payment and buys out the bank's share month by month while paying a fair rental rate for the portion of the home he doesn't own yet. Zero interest, zero riba, fully Sharia compliant. His monthly payment for equity buyout and rent comes to about $1,517. Add property taxes at roughly $250 a month and homeowner's insurance at $130, and Usman is looking at around $1,900 per month going out the door. And that doesn't include maintenance. We'll get to maintenance. Idris rents a comparable place for $1,400 a month. No down payment required. He takes his $60,000 and drops it into a Halal Index ETF, averaging around 8% annually. His monthly housing cost is $500 less than Usman's. He has no mortgage, no property taxes, no maintenance responsibilities, and a growing investment portfolio working in the background. On day one, Idris looks like the smartest person in the room. He's paying less, investing more, and sleeping soundly, knowing that if the furnace explodes at 200 a.m., it's somebody else's problem. But there's something Idris doesn't realize yet. Something that won't become visible for several years, but will eventually define the entire outcome. Every dollar Usman pays is slowly buying him a piece of something real. Every dollar Idris pays disappears the moment it leaves his account. And that distinction, compounded over time, is worth a lot more than $500 a month. Let me walk you through the first 3 years, because for the first 3 years, Idris is winning, and it's not even close. Idris is living light. The furnace breaks. He calls the landlord. The roof leaks. Someone shows up and fixes it. The dishwasher dies. It gets replaced. Idris doesn't pay a dime for any of it. His only costs are rent, renter's insurance at maybe $15 a month, and utilities. No surprises, no 5-figure repair bills showing up on a random Saturday. And his $60,000 in the Halal ETF at 8% annual returns has grown to roughly $75,600 by the end of year 3. Idris hasn't added a single dollar. His capital is just compounding quietly, generating purified returns in the background. Usman is having a completely different experience. Closing costs hit him for about $9,000 on day one before he's even moved a single box into the house. Appraisal fees, title insurance, legal costs. Then property taxes start coming. Insurance premiums, maintenance at 1% to 2% of his home's value per year. That's $3,000 to $6,000 annually just to keep the place from falling apart. A water heater here, a fence repair there, a plumber at 1100 p.m. on a Wednesday because the toilet decided to become a fountain. Here's the financial scoreboard through year 3. Idris has paid roughly $50,400 in rent and holds a $75,600 Halal index fund. Usman has spent over $103,000 between his partnership payments, closing costs, taxes, insurance, and maintenance, with only about $9,500 in equity built through principal buyouts. His home might have appreciated slightly, but not enough to close that gap. Through year 3, Idris is ahead by almost every measure. He's spent less, he has more liquid wealth, and he has more flexibility. If someone offers Idris a job in another city tomorrow, he packs his bags. If someone offers Usman that same job, he has to sell a house, and selling a house in year 3, after closing costs and agent commissions, often means taking a loss. So if the story ended at year 3, the answer would be obvious. Rent, invest the difference, and don't look back. But the story doesn't end at year 3, and what happens next is where most people's understanding of this debate falls apart completely. Idris's lease comes up for renewal. Rent goes up 4%. That's $56 more a month. He barely notices. $1,400 becomes $1,456. The next year, $1,514. Then $1,575. Each increase feels manageable in isolation. It's never enough to make Idris panic or reconsider his strategy. It's just enough to quietly eat into his budget a little more every single year. Now look at Usman's payment under Diminishing Musharaka. $1,517 for his equity buyout and rent share. The exact same number he paid on month 1. The same number he'll pay on month 120. The same number he'll pay on month 360. For 30 years, that baseline number does not move, not once. This is the quiet mechanism that most people miss in the rent versus buy debate. Rent is a variable cost that only trends in one direction, up. Fixed financing is a constant cost that inflation slowly makes cheaper in real terms. In year 1, Usman's payment feels heavy. By year 10, it feels normal. By year 20, it feels almost cheap. By year 30, it feels like a rounding error compared to market housing costs. Idris's rent does the exact opposite. It starts comfortable and gets heavier every single year. Like a backpack that someone adds a pebble to each month. You don't notice the first 50 pebbles. By pebble 200, you're hunched over. Let me put real numbers on this. Idris's $1,400 rent growing at 3.5% per year, which is conservative by recent standards, becomes roughly $1,870 by year 10, about $2,510 by year 20, and approximately $3,370 a month by year 30. Usman is still paying his $1,517. At the end of 30 years, the exact moment Usman makes his final buyout payment, takes full ownership from the bank, and starts living in his home for practically free, Idris is paying over $3,300 a month for the privilege of living in someone else's property. And he'll keep paying it. Next month, the month after, for the rest of his life. Something shifts around year 4 or 5, and by year 6, the math has quietly reversed in Usman's favor. Usman's home has been appreciating. Historically, real estate grows at roughly 3% to 3.5% per year on average. At 3.5% annual appreciation, Usman's $300,000 house is worth about $347,000 by the end of year 6. Meanwhile, the bank's remaining share has dropped to around $269,000. That means Usman is sitting on roughly $78,000 in equity. Here's what makes this interesting. Usman didn't put $78,000 cash into the house. He put $60,000 down. The rest came from appreciation on a $300,000 asset that he controls. That is leverage. Usman is earning appreciation on $300,000, not on his $60,000. When the house goes up 3.5% in a year, that's $10,500 in appreciation. On a $60,000 investment, that's an effective return of 17.5%. Idris's Halal ETF is returning 8%. Usman's asset capital is working more than twice as hard because leverage multiplies the return on the capital actually invested. Idris's ETF portfolio has grown nicely too, reaching $95,000 by year 6. That's a solid $35,000 gain. But Idris only earns returns on the money he actually invested. There's no leverage, and Idris's rent is now creeping past $1,600 a month. Now, let me talk about something the Rent Forever crowd rarely addresses. Rent has no finish line. At 35, you pay rent. At 55, you pay rent. At 70, retired on a fixed income, you still pay rent, and that rent is at an all-time high. Your income in retirement is lower, but your rent is higher, and there is no month where that equation reverses. Home financing has a finish line. It has a specific date on the calendar where the payments stop and you own a piece of the earth outright. Your housing costs drop to property taxes, insurance, and maintenance, maybe $600 a month. Idris, at that exact same moment, is writing a check for $3,370 plus to a landlord. Now, let me be honest about the other side. Buying a home comes with real costs and risks. Maintenance is relentless. A new roof costs $8,000 to $15,000. An HVAC system runs $5,000 to $10,000. Property taxes can rise. Your equity is trapped inside walls. You can't spend it on groceries during a crisis. A house is an illiquid asset, and illiquidity is dangerous when life throws an unexpected curveball. Here's where the full story comes together. The 10, 20, and 30-year scoreboard. Over 10 years, Idris has spent roughly $193,000 on rent. His Halal ETF, assuming he didn't touch it, has grown to about $129,500. Net position, negative $63,500. Usman has spent roughly $285,000, payments, taxes, insurance, maintenance. But his home is now worth approximately $423,000, and his remaining share owed to the bank is down to $253,000. That's $170,000 in equity. Netting it out, Usman is ahead of Idris by $40,000 to $60,000. By year 20, Usman's home is worth over $500,000, and his equity crosses $350,000. By year 30, Usman makes his final payment and owns a home worth over $700,000 outright. His monthly housing cost drops to practically zero. Idris is paying $3,370 a month to a landlord for the rest of his life. But I need to be brutally honest about one critical assumption in this entire analysis. The rent and invest the difference strategy only works if Idris actually invests that saved $500 every single month for 30 years without ever touching it. And that's where theory meets human nature. In theory, Idris invests the difference. In practice, that $500 gets absorbed by wastefulness, israf, and giving in to the ego, nafs, a nicer car, dining out, luxury vacations, sales at the mall. A self-directed investment strategy requires a level of iron discipline that 95% of people simply do not maintain for 3 decades. Home financing through Musharaka acts as a forced savings mechanism. Every single month, whether you feel like it or not, a portion of your payment increases your share in the asset. You don't have to rely on willpower. The structure does it for you, turning your wealth into amana, a responsible asset for your family's future. Idris and Usman both made their choice. Idris thought he was staying flexible. Usman was building a permanent foundation without riba. The real trap isn't renting, and it isn't buying. The real trap is making a $300,000 decision based on month 1 numbers without ever asking what it costs your family over 10 years, 20 years, and a lifetime. Subscribe to Brother Explains Money if you want the real math and honest breakdowns. I'll see you in the next one.